All right, listen up. It's the end of 2025. The market's gone wild with AI this, crypto that. Everyone's chasing the next big thing, the next 10-bagger, the next rocket to the moon. But hold on a second, let's get real. I'm looking at my screen and I see a crisp, fresh $10,000. The question on everyone's mind is, what would the master do? What would Warren Buffett, the Oracle of Omaha, do with this money right now? Not $1 billion, not 100 million, just 10 grand. The kind of money you, the hard-working investor, have saved up. It's time to put the noise on mute and tune into the wisdom that built a fortress of wealth. We need a plan, a real strategy, not a lottery ticket. The world has changed, no doubt. We have self-driving cars zipping around and AI making decisions faster than we can blink. But the fundamentals of making money? The core principles of building real, lasting wealth? Those haven't changed one bit. Buffett would tell you that himself. He wouldn't be chasing some hot tech IPO that has no earnings. He wouldn't be gambling on a company whose business model he can't explain in a single sentence. No. He would start with the basics, the bedrock principles that are as true today as they were 50 years ago. So let's put ourselves in his shoes. Imagine Warren sitting in his office in Omaha, not with a fancy Bloomberg terminal, but with his annual reports and a can of cherry Coke. He sees your $10,000. He's not thinking about how to double it by next Friday. That's a sucker's game, and you're no sucker. He's thinking about how to turn that 10,000 into a much, much larger sum over the next 10, 20, or even 30 years. He's thinking about ownership. He's thinking about businesses with staying power. He's thinking about a future where your money works for you while you sleep. Booyah! That's the real American dream, folks. This isn't about finding a magic formula. It's about discipline. It's about thinking for yourself and ignoring the screaming headlines and the panic sellers. Buffett's approach is brilliantly simple, but it's not easy. It requires patience in a world that demands instant gratification. It requires you to do your homework when everyone else is just copying their neighbor. So grab a notepad. Get ready to take some notes. We're going to build a Buffett-style portfolio with just $10,000, and we're going to do it the right way, starting right now in the final days of 2025. Let's make some real money. Here's the first lesson, and it's a big one. You are not buying stocks. Get that idea out of your head. You are buying pieces of actual businesses. When you buy a share of a company, you become a part owner. You own a tiny slice of their factories, their brands, their patents, and their future profits. Buffett doesn't see a ticker symbol flickering on a screen. He sees a company with real employees, real customers, and real products. This mindset shift is everything. It changes the game from speculative gambling to long-term investing. You have to ask yourself, is this a business I would want to own entirely if I had the money? So, what makes a business great in Buffett's eyes? Look for companies with a durable competitive advantage, what he calls a moat. A moat is something that protects a company from competitors, just like a moat protects a castle. It could be a powerful brand name that everyone trusts, like Coca-Cola. It could be a low-cost advantage, like Walmart or Costco, that allows them to sell things cheaper than anyone else. It could be a network effect, where the more people use the service, the more valuable it becomes, like Visa or MasterCard. These moats keep the competition at bay and allow the company to earn high profits for years and years. The next step is to buy these great businesses at a fair price. You don't want to overpay, even for the best company in the world. As Buffett famously said, it's far better to buy a wonderful company at a fair price than a fair company at a wonderful price. This means you have to be patient. You wait for the market to give you an opportunity. Sometimes Mr. Market gets scared. He panics, and he offers you incredible businesses on sale. That's when you step up to the plate and swing. You're not trying to time the bottom perfectly, you're just trying to pay a price that makes sense for the long-term earning power of the business. And once you buy, you hold. This is where the magic of compound interest comes in. Albert Einstein called it the eighth wonder of the world, and he was right. When you own a great business, it generates profits. The company can then reinvest those profits to grow even bigger, which leads to even more profits. Over time, this cycle creates a snowball of wealth that grows bigger and bigger. You're not jumping in and out. You're letting your money do the heavy lifting for you, year after year, decade after decade. That's the Buffett way. That's how you win. In this crazy market of 2025, everyone is chasing the shiny new object. AI is the buzzword on every analyst's lips. But Buffett? He'd be looking where no one else is. He would be systematically hunting for value, not following the herd. He'd probably start by looking at smaller companies, the ones that are too small for the big Wall Street funds to even bother with. These are the companies that get overlooked, the hidden gems that are just quietly making money, year in and year out. He'd be reading the annual reports of companies you've never even heard of, looking for a simple, understandable business model. The key is to work within your circle of competence. This is a crucial Buffett idea. It means you only invest in businesses that you truly understand. If you can't explain what a company does and how it makes money to a 10-year-old, you have no business owning its stock. It doesn't matter if it's the hottest tech company on the planet. If it's outside your circle, you stay away. For Buffett, that might mean candy companies, insurance, or railroads. For you, it might be something different based on your own career or hobbies. Stick to what you know. This simple rule will save you from making a ton of mistakes. This process is about independent thinking. Buffett doesn't care what I think, what other pundits think, or what the popular opinion is. He does his own research and comes to his own conclusions. He's famous for saying, "Be fearful when others are greedy, and greedy when others are fearful." This means you have to have the courage to go against the crowd. When everyone is panicking and selling good companies because of some bad news, that's your chance to be greedy and buy. When everyone is euphoric and throwing money at speculative nonsense, that's your signal to be fearful and cautious. So, how do you find these companies? You become a detective. You screen for stocks with low price-to-earnings ratios, strong balance sheets with little debt, and a history of consistent profitability. You read trade magazines in industries you understand. You look at the products you use every day and ask, who makes this? Is it a good business? The answers are often hiding in plain sight. It's not about having a secret algorithm. It's about putting in the work, thinking like a business owner, and having the discipline to wait for the right pitch. It's hard work, but it's where the real money is made. Now, I know what you're thinking. Jim, that sounds like a lot of work. I have a job, a family. I don't have time to read hundreds of annual reports. And you know what? Buffett gets it. He has a solution for you, and it's one of the best pieces of financial advice ever given. For the vast majority of investors who don't have the time or the desire to become expert stock pickers, he recommends a simple, low-cost S&P 500 index fund. That's it. It's his secret weapon for Main Street, and it's a powerhouse of wealth creation. Booyah! Why an S&P 500 index fund? Because when you buy it, you are instantly diversified across 500 of the largest and most successful companies in America. You own a piece of Apple, Microsoft, Amazon, and hundreds of other corporate giants. You are betting on the long-term success of the American economy, which has been the greatest engine for prosperity the world has ever known. You don't have to worry about picking the right stock or avoiding the wrong one. You just own the whole haystack instead of trying to find the needle. It's a simple, elegant, and incredibly effective strategy. The other critical part of this is low cost. You have to watch out for fees. Fees are like termites. They silently eat away at your returns over time. High-cost mutual funds run by managers who are trying to beat the market often fail to do so, and they charge you a fortune for the privilege of underperforming. A low-cost index fund, on the other hand, just tracks the market and charges you a tiny fraction of a percent. Over decades, the difference in returns between a low-cost index fund and a high-cost active fund can be hundreds of thousands of dollars. Buffett has hammered this point home for years, and he's 100% right. Let's be clear, this isn't a get-rich-quick scheme. Owning an index fund is the ultimate get-rich-slowly plan. There will be years when the market goes down. There will be scary headlines and moments of panic. Your job is to do nothing. Just keep buying, month after month, year after year, and let the power of the American economy and compound interest do the work for you. In his will, Buffett has even instructed that 90% of the cash left to his wife be put in a very low-cost S&P 500 index fund. If it's good enough for the Buffett family, it's certainly good enough for you. Okay, let's put our money where our mouth is. You've got $10,000 ready to go. How do we build a Buffett-style portfolio for 2026? We're going to keep it simple, focused, and powerful. We're not going to spread it across 50 different things. We're going to make concentrated bets on high-quality assets. The first and most important part of this plan for a new investor is the S&P 500 Index Fund. This will be the core of your portfolio, your foundation for long-term growth. It's the safest, most reliable way to bet on the future. Here's the blueprint. Take $8,000 of your $10,000, that's 80%, and put it directly into a low-cost S&P 500 index fund. I'm talking about funds like the Vanguard 500 Index Fund, VFIAX, or the SPDR S&P 500 ETF, SPY. The expense ratios on these are incredibly low, meaning more of your money stays in your pocket, working for you. You don't put it all in at once. Maybe you put in $2,000 a month for 4 months. This is called dollar cost averaging. It takes the emotion out of it and ensures you don't accidentally invest everything at a market peak. It's a disciplined approach. Now, what about the other $2,000? This is where you can be a little more active if and only if you've done your homework. This is your Buffett stock picker money. You can use this to buy 1 or 2 individual companies that you believe are truly wonderful businesses, selling at a fair price. Think about companies with massive moats. A company like Apple, with its incredible brand loyalty and ecosystem. Or maybe a company like Berkshire Hathaway itself, BRKB, which gives you instant diversification and management by Buffett's own team. You're looking for a business you understand and can hold for a decade or more. The key with this $2,000 is to treat it with extreme care. This isn't play money. This is you acting as a serious business analyst. You read the annual report. You understand the competition. You have a clear thesis for why this company will be bigger and more profitable in 10 years. If you don't feel confident doing this, guess what? You put that $2,000 right into the S&P 500 index fund along with the rest. There is no shame in that. In fact, it's the smartest move for 99% of people. The goal is to build wealth, not to prove you're a stock-picking genius. Simplicity wins. If you want the real secret to the Buffett method, it's not some complex algorithm or inside information. It's a one-word answer: patience. In a world that moves at lightning speed, where traders are making 1,000,000 moves a second, the ultimate advantage is the ability to sit still. Warren Buffett has made most of his money by buying great companies and then holding them for decades. He let them grow, compound, and mature. He calls it his sight-on-your-ass strategy. It's not flashy, it won't give you a thrill every day, but boy, does it work. It's the closest thing to a superpower in the investment world. Think of investing like planting a tree. You don't plant a sapling and then dig it up every day to see if the roots are growing. That's madness. You plant it in good soil, you make sure it gets water and sunlight, and then you let it grow. You give it time. Your investment portfolio is the same. Once you've bought your index fund or your wonderful business at a fair price, your job is mostly done. Now you have to fight the urge to meddle. You have to ignore the noise from financial television, yes, even from guys like me sometimes, and let your plan work. Patience also means waiting for the right opportunity. Buffett compares investing to being a baseball batter, but with a twist. In this game, there are no called strikes. You can stand at the plate all day and watch thousands of pitches go by. You don't have to swing at everyone. You can wait for the perfect pitch, the one that's right in your sweet spot. The market will throw you all sorts of crazy pitches. Overvalued IPOs, speculative fads, complicated derivatives. You can just let them go by. You only need to swing a few times in your life, as long as you connect when you do. This is why independent thinking is so critical. The crowd is impatient. The crowd is emotional. The crowd buys high and sells low. Your patience allows you to do the opposite. When the market is in a frenzy, you can patiently wait on the sidelines with your cash. When the market is panicking and everyone is selling indiscriminately, your patience allows you to calmly step in and buy those wonderful businesses that are now on sale. This discipline, this ability to control your own emotions and act rationally, is what separates the amateur from the master. It's the true secret sauce. Let's draw a bright red line in the sand. On one side you have investing, on the other you have speculation. They are not the same thing. Investing in the Buffett sense is the act of deploying capital to buy a productive asset with the expectation of generating a solid return over a long period. You are analyzing the underlying value of the business. Speculation, on the other hand, is betting on price movements. You're hoping that the stock you buy today will be bought by someone else, a greater fool, at a higher price tomorrow, without any regard for the company's actual performance. Buffett would tell you that much of what passes for investing today is really just speculation in disguise. People chasing meme stocks, day trading volatile tech names, or gambling on cryptocurrencies with no intrinsic value are not investing. They are playing a game of hot potato. Sometimes you can make money that way, but it's pure luck, and it's a dangerous game that almost always ends in tears. The house always wins in that casino. You want to be the house, not the gambler. You do that by owning the casino, not by playing the slots. To avoid the speculation trap, you must always think like an owner. Before you buy a single share, ask yourself this question. If I had to buy the entire company and I couldn't sell it for 10 years, would I still make this purchase? This simple mental exercise forces you to focus on the long-term fundamentals of the business. It makes you think about its durability, its management team, its competitive position, and its future earning power. It completely removes the temptation to worry about what the stock price will do next week or next month. Who cares? You're an owner, not a flipper. This ownership mindset protects you during market downturns. When the stock market crashes, speculators panic. They see their account balances flashing red and they sell everything, locking in their losses. But an owner has a different perspective. An owner sees the downturn as an opportunity. If you loved owning a piece of a great business at $100 a share, you should be ecstatic to buy more of it at $70 a share. The underlying business hasn't changed, only its price tag has. Thinking like an owner gives you the emotional fortitude to not just survive market volatility, but to profit from it. All right, we've talked about what to buy and how to think. Now let's talk about where to buy it. This part is crucial, and so many people get it wrong. You want to use the government's own rules to your advantage. The best way to do that is by investing within a tax-advantaged account. I'm talking about a Roth IRA or a traditional IRA. These accounts are like a supercharger for your investments. They are your absolute best friend on this journey to building wealth, and Buffett would insist you take full advantage of them. They are a gift. Let's break it down. With a Roth IRA, you contribute money that you've already paid taxes on. But here's the magic. All of your future growth and all of your withdrawals in retirement are 100% tax-free. Let that sink in. You could have $1 million in your Roth IRA and you won't pay a single penny in taxes to Uncle Sam when you take it out. All those decades of compound growth, all those dividends, completely tax-free. It is, without a doubt, the single best deal available to a long-term investor. If you're eligible, you should be maxing out your Roth IRA every single year. A traditional IRA works a bit differently. You might get a tax deduction on your contributions today, which lowers your taxable income right now. Your money then grows tax-deferred, meaning you don't pay taxes on the growth each year. You only pay taxes when you start taking the money out in retirement. This can also be a great option, especially if you're in a high tax bracket now and expect to be in a lower one when you retire. The important thing is that both types of IRAs protect your investments from the annual drag of taxes on dividends and capital gains, letting your money compound much faster. Putting your $10,000 Buffett portfolio inside one of these accounts is a no-brainer. Imagine your S&P 500 index fund spitting out dividends every quarter. Inside an IRA, that money can be reinvested to buy more shares without you having to pay any taxes on it. Outside of an IRA, you'd get a tax bill every single year, which nibbles away at your principal and slows down the compounding machine. Using a tax-advantaged account is like running a race without a parachute on your back while everyone else is being dragged down. It's a massive advantage that you simply cannot afford to ignore. So here we are. We've laid out the Buffett plan for your $10,000. It's not about timing the market. It's not about finding some secret stock tip. It's about a disciplined, informed, and patient process that works. The final and most important lesson is to understand that this is a long game. We're not planning for next quarter, we're planning for the rest of your life. Victory in investing is not measured in days or months. It's measured in decades. Your success will be determined by your ability to stick to the plan, through thick and thin, for years and years. Your plan for the first decade is simple: save and invest consistently. After you've invested your initial $10,000, your job is to keep adding to it. Every single month, you should automatically transfer money from your paycheck into your investment account, preferably your Roth IRA. You put that new money into your low-cost S&P 500 index fund. You don't worry about whether the market is up or down. You just buy, systematically. This relentless accumulation is what builds the foundation of your wealth. In 10 years, that initial $10,000 plus your consistent contributions will have grown into a significant sum. In the second decade, you'll really start to see the power of compounding take off. The money your investments are earning will start to become a noticeable force. It will feel like you have a silent partner working for you 24/7. During this period, your biggest enemy will be your own impatience or fear. There will inevitably be a market panic or a recession. The headlines will be screaming, "Sell." Your job is to stay disciplined. You remember that you are an owner of great American businesses, and you keep buying. Your courage during these times will be handsomely rewarded in the years that follow. By the third decade and beyond, the results will be staggering. Your investment portfolio will likely be worth more than all the money you ever personally contributed. The growth from your investments will be doing almost all of the work. This is the end game. This is the financial freedom that Buffett's principles promise. It didn't come from a lucky bet. It came from decades of disciplined choices, from thinking like an owner, from keeping costs low, and from having the patience to let a simple, powerful plan work its magic. This is the Buffett plan. Now go out there and execute it. Booyah!